Thursday, July 27th, 2023, Maneco 64, home of alternative economics and contrarian views. We're going to look at whether the Fed and all the other major central banks are really winning the war on inflation. In my opinion, it's not as clear cut as Wall Street and probably the Fed economists want us to believe, or even governments, I would say. I think it's much worse. Before we go into that topic, the main topic for today's report, just look at some headlines to do with the BRICS summit, or a story that I saw this morning, an opinion piece from the FT. Of course, they're very disparaging about the BRICS. This guy, Alan Beatty, says how the BRICS nations risk becoming satellites of China. So he also mentioned the fact that Putin will not be able to attend because of this international arrest warrant they have for him. And I think actually in the West, there's a lot of denial, and people are not really looking at the importance of what the BRICS are trying to do. And do I think they're going to announce a new currency at the summit? I think it starts August 22nd. I don't think it really matters. What matters is that countries like China and many others are moving away from the dollar very quickly. I saw this here the other day from Gold Telegraph, and he tweeted out the yuan was used in 49% of China's cross-border transactions last quarter, topping the dollar for the first time. This is huge news. Many countries to be in denial. The world's second largest economy has the dollar in its crosshairs and is stockpiling gold. Enjoy the wild ride. So that's what I'm trying to say here. Even if there is no announcement of a currency or some kind of gold settlement system, I don't think this is going to stop. And it's not just going to be China. It's going to be other countries. And we've seen China do deals with many other countries, and even other countries doing cross-border deals with each other. And the only way for these countries really to keep a tab on things and settle their trade deals would be ultimately to extinguish their debt, for example, into gold. Because gold is the ultimate form of payment. Of course, the FT is not going to talk about that. This guy here does mention the BRICS currency, but he just goes over it, and he tries to say that only China is the only economy that's doing well, and he poo-poos the other members of the BRICS. And he also poo-poos the fact that there's many other countries that want to join the BRICS. So what's my view on it? My view is I'm not trying to drum up any kind of support or how can I say cheerleading for the BRICS. All I'm trying to see here is that these countries, BRICS and others in the emerging markets, are trying to move away from being dependent on the dollar and Western finance in general, because we're in trouble in the West. We are up to debt, up to here in debt, and of course there are a lot of BRICS countries that are up to here in debt. But be as it may, I think there will be a lot less demand for our currencies, and that's what we need to keep in mind. And we need to act like a central bank or a bank. We need to keep our reserves, raising our reserves of real money, i.e. gold and silver. Of course, we're not going to buy as much as China or other sovereign countries, but we're just a little microcosm of a sovereign, I would say. So I thought that was interesting, and yeah, my view is that you shouldn't buy gold just because you think there's going to be some new currency announced in a few weeks' time. You should be doing it for the right reasons, because the Federal Reserve and other central banks, they have not won any war against inflation, in my opinion. And the reason why we're hearing this now from the mainstream economic world is that they look at inflation differently than we do. They look at inflation not as the excessive creation of currency and credit out of thin air, but they look at it as a measure of price, which the Austrian school is always try to guard against, and they've been warning that it's not the best way to do it. Ever since the 1920s, Friedrich von Hayek predicted that despite the fact that CPI was very stable in the 1920s, that things could end up in tears because the credit system was being inflated massively, and that's how I look at inflation. It's more to do with the credit and currency bubble of the fiat system. So this morning, I've just read this article here from the FT regarding the Fed's decision to hike. It says, last hike of the cycle, economists predict Federal Reserve is done with interest rates. Likelihood of more tightening lessens, with U.S. central bank seen to be winning its war on inflation. So by inflation, of course, they mean the CPI, which has been doctored many times over. And why do these economists play this game? Well, because they work for them. All the major economists work on Wall Street. They work for hedge funds, for bond funds, and they need to talk their book. They need to, convince the markets that the Fed has everything under control, so that bond yields drop back and their bond values go back up. And I'm sure that's what the Fed wants. I think ultimately the Fed will resort to what the Bank of Japan has been doing. And what is that? Well, it's yield curve control. And that's not quite QE, but it might require QE. So what is yield curve control? Well, the Federal Reserve can come out and say, we won't let the 10-year yield go above 4%. So right now, I think, let's have a quick look. The 10-year yield has dropped to around 384. It was above 4% 2 or 3 weeks ago. So if the markets drive these yields back up above 4%, and how does that happen? Well, investors and speculators start selling the 10-year Treasury. Then the Fed will step in and buy as much of those 10 years necessary to drive the yield down. So how do they do that? Well, it would be through QE, and the Bank of Japan did that late last year and early this year, because the yields on the JGBs went above 0.5%, the 10-year JGB, the Japanese government bond. So I think that's what Wall Street expects. And I think a lot of people at the Fed, they're hoping and praying for that because we know that the national debt in the U.S. is out of control. They suspended the debt ceiling for 18 months, a couple of months ago, and the debt is going to soar. Even the Congressional Budget Office sees the national debt double, basically, the one held by the public, to almost 50 trillion by 2033. So you can bet it's probably going to be even more. And the Fed is in a tough situation here. And I'm not too sure whether, even in terms of what they consider inflation, which is the CPI, that they've won anything. because I see commodity prices rebounding massively, and that's going to put a lot of pressure on the central banks to raise rates again. I've seen here in the UK that HSBC has cut mortgage rates, and a big deal has been made out of that. But I personally don't think they've won the war on inflation, mainly because they create the inflation, and they don't want to stop inflation. And by inflation, in this sense, I mean the creation of currency and credit, because it's a Ponzi scheme, and you stop the Ponzi scheme going, everything collapses, because when they issue debt with interest, the interest is not doesn't exist. The money to pay the interest doesn't exist, and that's the whole problem. And why do I think they haven't won the war on inflation? Well, there's one important thing that makes me believe that, and don't forget, these people were the same people 2.5 years ago who said inflation was transitory. It was going to come back down in 2022, back to 2%. So they've been wrong, and I think they're going to be wrong again. And why? Well, because none of the major central banks, the Fed included, ever kept real rates above the rate of CPI. Maybe right now it is a little bit, but it needs to stay there much longer, and that's if you believe the CPI that we have, which is around, I don't know, 3%. Yes, rates are above 5%, but here in the UK we're nowhere close to real rates being positive. In the US they are right now, I guess. They're just about positive if you look at the 2-year. The 2-year is trading around, let's see here, 4.8. So yeah, with rates around 5.25, it's just becoming positive. But the other countries, like in the EU and the UK, they haven't done that. So that's why I think it's not over, and the Austrians are going to be proven right. And I think there's still a lot of accidents there that could happen. The hope, of course, is that yields stay under control, and that's why we need to keep an eye on it. I personally think, as I said, they're going to have a tough time. And a lot of, you read this article here, and I'm going to put a link to it. It is behind a paywall, but I put it under archive.ph. A lot of people, these economists, think that the battle is won, but Powell said he's not too convinced. That he's tried to talk tough. I personally think he doesn't really know what's happening. What about gold and silver? Well, I think it's still a great place to be, especially with all the debt and the deficit spending. That's what we need to focus on. And the other thing that's going to hurt the dollar, the pound, and the euro is the move away by the BRICS and emerging market countries to their own kind of monetary club, so to speak, or system. They're going to try to avoid keeping as much reserves in dollars and in euros, or even in pounds. So that will mean less demand for our bonds. And maybe that's why the central banks are going to have to keep doing some kind of QE or yield curve control. And that's what Japan's been doing. Look at the Japanese debt. It's up to 300% of GDP. And the same thing could happen in the US. That would be a result, actually, if they could keep things going. The other side of the coin is that they can't keep things going. Rates go through the roof and the whole system implodes. And either way, you want to have gold, because you've seen the price of gold in Japanese yen, which I've covered. It's at an all-time high, almost at 300,000 yen. So what I'm trying to say here is that the Fed and the major central banks, They would love to have a situation like in Japan. That would be a way of perpetuating the system. And only time will tell if we'll get that. So enough of that. Let's quickly look at the markets this morning. It's 8 a.m. London time. We got spot gold at 1974. It's up a couple of dollars. The low has been 70. The high has been 1982. So we've had, 18 months almost of rate hikes. I think it's a little less. And rates have gone from 0 to 5.25. And I think gold was pretty much where it is now when they started raising rates. So much for the collapse in gold. Silver is unchanged, 24.92. High's been 25.15. The low has been 86. The Dow futures is up 10. NASDAQ futures is up 100. S&P is up 14. To the currencies, sterling is up slightly, 0.1% at 129.56. The euro is up a little more. It's up about 0.2 at 111.02. The dollar is down slightly versus the yen, just above 140. And the dollar is down 0.15 versus the yuan at 714. To the Aussie dollar is up 0.2%, just below 68. And the dollar is down 0.25% versus the Canadian dollar, 131.75. And the Kiwi dollar is up 0.2% at 62.50. To the general commodities, WTI crude is up 1% at 79.40. Brent is up 0.8% at 83.23. We've got platinum trading around 970. That's up about $3. High grade copper is up slightly at 391.60. We've gone over the U.S. Treasury rates, but let's quickly look at the UK government bond rates. The 2-year gilt yield is back above 5%, around 5.05. So that's not a good thing. It did drop below 5, but now it's picked back up. The 10-year is kind of under control right now. It's at 4.29. So there you go. With that, I'm going to wish you all a very good day. Take care. Bye.